Hi, I'm Patrick Donahoe, and I want to welcome you to the final episode of the Perpetual Wealth Strategy podcast summer season, where we are doing a deep dive into the hierarchy of wealth. I hope after today's episode that you will have a more comprehensive understanding of how to structure your current investments to better form your financial foundation and ultimately weather market fluctuations in the future, as well as achieve your goals with more certainty. My guest today is a seasoned wealth strategist. He's been with Paradigm Life for about a half a decade now, but he has an extensive background in financial services and understands tier 4 investments at a very high level. And he has helped me to understand them, not from my vantage point, but from the client's vantage point, from your vantage point, and how you have been trained and taught and conditioned to invest in a certain way and to position your assets in a certain way. So Chad is an expert, and I know you guys are going to benefit from this podcast. It was a great way to end this series. So welcome to the Perpetual Wealth Strategy podcast. Hey, everyone. Thank you for joining this podcast. It is our final in talking about the hierarchy of wealth, and we're going to be talking about tier 4. And I have my good buddy and a wealth strategist, very seasoned financial professional, Chad Hanson, on with me. Chad, how are you, my friend?
Fantastic. Thanks for having me on. It's going to be a good discussion.
I think so. You know, Chad, I think it'd be good for you maybe to review your history, right? That you've been in financial services for a pretty long time, almost 20 years, maybe even beyond 20 years. And, you know, what that's made you aware of when it comes to, you know, specifically the tier 4 type of asset that it has the most risk out of all the other tiers that have already been discussed.
Yeah. Okay, great. Yeah. So as far as background goes, so I started in this industry in 99, so 21 years ago. Started out as a stockbroker, registered investment advisor, registered fiduciary, retirement planning counselor, estate planning counselor, group benefits specialist, employee benefits consultant, life and health insurance agent, property and casualty insurance agent, real estate investor, entrepreneur, and business owner. Clients currently in 48 out of the 50 states, a dozen or so internationally as well. So I spiel all that out just to say I've been around the block a few times, right? I don't know that I've seen it all and done it all financially, but pretty darn close. So we're specifically talking about tier 4. That's really where my foundation in this business began. You know, a stockbroker on Wall Street, right? Just thrown into the fire. And I'll tell you, it's a lot of fun, but it's something that has to be done very, very cautiously. You have to have an extra measure of diligence when you're dealing with tier 4 assets. And that's unfortunately not the way that we are taught. And you'd agree with this, Patrick. I mean, you go to school and they tell you, you know, go invest in stocks and bonds and ETFs, and why not throw in some options and futures and commodities? And nobody knows what that means, but they go to their broker and they ask for that, and that's what they get. And they're kind of starting with that hierarchy of wealth upside down. They're kind of starting at the tip instead of establishing the base and then moving up. And it gets a lot of people in trouble. You know, just in my history in this business, you know, I started in 99. And if you think about what was going on in 99, I mean, it was the end of the 90s. The market was just rallying, going crazy.
Tail end of .com, yeah.
Yeah, tail end .com. You could throw a dart at the Wall Street Journal and make 30%. It was just didn't matter what you invest in. Everything was going up double digits. Well, you know, then there was the WorldCom and the Encom debacle, and Enron debacles, and all of the .coms going under, and the market just tanked and caught everybody by surprise. So that was my intro into this world. You know, a couple of years in, and the world collapses. You know, we licked our wounds, went back to our modern portfolio theories, redesigned, reallocated everything, went and sought out the best advice, the best portfolio managers, spread everything out as far as we could, did our best job of diversification. A couple of years later, 9/11 hit, and you know, slam, we got just worked over again, and it was completely out of our control. No matter how good of a job we did, we could not stop the bleeding. We could not stop the hemorrhaging of wealth from our clients' portfolios. It didn't matter if they were in stocks or bonds or ETFs or anything else, they were losing money. And it was a hard lesson to learn early in my career, and it kind of started me on the path to where we are currently.
Mm.
And obviously we've seen a bunch of things since then, like the 2008, 2009 real estate crisis and the current COVID-19 situation we're in. You really have to have a good solid foundation, and you have to work your way up that hierarchy of wealth intentionally. You can't just haphazardly throw a dart at the Wall Street Journal anymore and hope to make it big. It just doesn't work.
Well, as much as I'm assuming you've seen a lot of the evolution of technology, of systems, of the use of options and hedging and insurance. I mean, it's gotten a lot more sophisticated, but at the same time, the principle of trying to predict the future is still, the very difficult, because human nature is that variable that you can never. I would say human nature and humanity, right? Things happening, black swan events and so forth, life happening,
Yeah.
where you can't always predict
Right.
everything. And so that's where, even though there's room and a place for investments that have a degree of risk, you essentially have a sequence in which you establish your wealth and establish your assets, so that when these types of events, COVID-19 is just another example where they throw you off kilter, it doesn't impact everything. Because if it impacted everything, now it goes even further impacting emotions, state of being, which makes it even more difficult to rebound.
Yeah, agreed. There's a catchphrase from one of the big companies out there. I forget who it was, but they always said, you can't predict, but you can prepare. Actually, I think that was Mass Mutual.
Mm.
Anyway, you can't predict, but you can prepare. And they're right to some degree. If you're using the wrong tools, it doesn't matter how prepared you think you are, you're still going to take a shellacking, So you really can't predict what's going to happen. These black swan events come around, who knows what. And just general factors in your life, a job loss, a divorce, a business failure, things happen that are going to change your plans. And your plans have to be flexible. They have to have that liquidity built in, and you have to have some guarantees. And that's not what Wall Street focuses on. That's not what these tier 4 assets are designed to do. These tier 4 assets are really designed to take a chance and make it big on something that you're comfortable with, you're familiar with, but knowing that there's a chance of loss, right? So you've already taken care of tier 1, you've got your wealth maximization account set up, you have this amazing machine working for you. You've grown into tier 2s and tier 3, and now you still have a little excess. I would call that your play money. Okay, so for example, I have an options trading account still. I trade options, and it's just my play money account, right? It's fun. Okay, it's not something I would do for a client. It's just my own little play money. It's something I know, something I'm comfortable with, something I'm familiar with, but it's not where I'm betting my future. It's not my serious retirement money. This is my fun money. So you got to keep that in mind and have a place for it. And the way I do options is basically putting in a hedge. Okay, I'm using covered calls. I'm using a call and a put simultaneously. So if the market goes up, you can lock in some gains. The market goes down, you can cut it off and not have losses. But it takes a lot of experience and B, a lot of money to be able to do that well. And the average person just can't do that. I have a lot of clients that say, well, hey, who would you recommend I go to do options? And I generally just say, I don't, right? Because you have to have so much money to make it worth it on a portfolio that the average individual just can't do it. A lot of
ones
these
that do it well don't do it I mean, they're part of their portfolio is that, but there's a lot of other pieces of their portfolio, especially big hedge funds, where there's a lot of stability within there, and there is a percentage that is used for those kind of asymmetric risk reward type of investments.
Absolutely, and that's kind of the key. The big hedge funds, big insurance companies, even fixed index annuities are often run with options. The insurance companies have billions of dollars, and they can easily buy options on all their holdings and positions, on thousands of positions at the same time, where the average individual could never dream of doing that, at least not to that scale.
Yep.
So if you want to participate in some of those things, there may be better ways to do it than just using your own money and trying to do it yourself. Look at an options hedge fund or an options trading platform like Andy Tanner's, or look at a fixed index annuity company that's doing that.
Well, Chad, let
So
me actually
yeah,
bring something up that I've thought about a lot, because there's pieces of us, like as a human being, that desires uncertainty, whether that's in the form of playing sports or going to the movies or going on vacation. But I think there's aspects of that in finance where there's this kind of intrigue associated with a shiny object, and the potential to make it to have that asymmetric risk reward where you bet a little but get a big gain. And we don't say that there's no room for that, but we also, in a sense, don't advocate not doing it, because there's a piece, I would say, of you that I think benefits from that. And when you have a foundation of certainty, especially if you have the other three tiers taken care of,
correct.
it puts you
Yeah,
in a position where you not only are able to identify opportunities, but you're able to have meaningful learning and meaningful education, because the emotion of like not being able to feed your family, right, or pay your mortgage, right, it doesn't exist, right. This
yeah,
is more of money, as you said, play money. It's risk money, right, where
correct.
you can have some learning experiences and get the wiggles of your uncertainty out.
Yeah, and I love where you just said learning experiences. That is really a great thing. I mean, it's hard to know what the difference between a mutual fund and an ETF unless you've done it, right? Or it's hard to really take it in and understand how they really work and what they can do for you without kind of playing with it. You can read about it, but until you've really done it yourself, it just doesn't click, right? So that's where that is great. And you're right. And that comes really from tier two, right? Tier two is educating yourself,
Mhm.
investing in yourself, building up your own personal capital, right? And maybe that's where you start to learn about some of these things and research some of these things that you want to try when you get to tier four.
Yep.
Um,
Great point.
so I'd say that's where that lies. Mutual funds, if we kind of go back to mutual funds for just a minute, Patrick, most people in America say they are comfortable investing in mutual funds because that's all they know. Because that's where their 401ks are invested, that's where their IRAs are invested, that's where their parents set up their accounts for them. That's just where they are. Most people don't understand what mutual funds really do and how they're designed, and how they're managed, I guess, either. So maybe that's a talking point that we can
Let's get into it. Yeah,
go
definitely.
through. Just
Because
yeah, just go through real
they've
quick.
evolved over the years, but at the same time, the mentality of people hasn't evolved with it.
Right. And that's still everyone's go-to. They're just saying, all right, I've got this 401k with 25 options and they're all mutual funds, and I'll just pick the ones that are the best performers and go.
Mhm.
That's a recipe for disaster, right? Because one, they're very fee intensive, right? Your average mutual fund is very expensive. Even a no load, people say, well, I can go to Vanguard and get no load funds. Well, the definition of no load is you can't have more than 0.25% in annual charges and fees. So you're still getting charged. It's just not as much as some of the others maybe. And then you have to look at pay for performance, right? Is this no load fund actually performing better because of these reduced fees than these other ones? And that's not always the case.
Mm-mm.
So you really have to be careful where you're investing and how you're investing it, and look at the style. If you're familiar with the Morningstar style box,
Mhm.
most people just pick 3 or 4 funds and they're all large cap growth funds. So they've just tripled or quadrupled their exposure to one tiny little market area
Mhm.
without knowing it. They've got a large cap growth fund, they've got an S&P 500 fund, they've got a
All
blended,
correlated. Yeah.
yeah, they've got all these funds and they're all in the same area. So they think they're diversified, but they're not. They've just doubled or tripled up in the same areas. And people need to make sure that they're truly getting diversification. And obviously, we can maybe help guide some of those. I do have clients that send me their allocations and say, hey, what do you think about this? And I tell them, here, you're all right here, right here, right here. And and sometimes I give them some guidance on how to change that. But like we said, I mean, most people are just assuming that that's where they're going to be safe and that's where their money is the best, has the best diversification and the best management. But they're really setting themselves up for failure, because because they have these ridiculous expenses. They're not managed well in general. Mutual funds generally lag the market. They don't beat the market in general. Most of them are lagging the market itself, or lagging the S&P 500. And so we have got all these people that are putting their faith in some random fund manager somewhere that is not even performing as good as the market is performing. And they're paying extra fees and expenses to do so. And really, it's just kind of a disaster in the back end. The difference between that and an ETF, if you're not familiar with ETFs, mutual funds trade once per day, 4 p.m. Eastern time. So it's the end of the market day. So bad news could hit in the morning. People could be trading all day long on that bad news. And by the time your fund trades at the end of the day, it's too late. You've sucked in the losses or whatever. Or if there's great news at the beginning of the day, people are taking advantage of that, capitalizing on that growth. And again, your fund trades at the end of the day, and again, it's too late. That's where the evolution of the ETF came in. So the ETF is an exchange traded fund, and that actually trades all throughout the day, just like a stock. So you could buy it or sell it instantly, and 2 minutes later make another trade. So it's just a little easier way to micromanage your account. But again, if that's not your forte, don't try to do it yourself. Get somebody in there who knows how to do that.
Well, Chad, one of the things too that maybe I'd like you could speak to is, as you set up Wealth Maximization Account and you do it in a way that optimizes cash value, if that's the piece that is being played, that's the objective. If there's other objectives like business planning or estate planning, but if it's purely for kind of a savings play, and you look at the return it gets, as you factor in taxes and fees, the marginal difference between what a fund would get, even if it's just a simple no load or no expense ETF, the marginal difference is not that much, but yet the amount of risks that's taken to get that potentially marginal increase in return is astronomical.
Absolutely.
And I look at we will post the Dalbar report that we get. It usually comes out once a year. Now they're putting it out quarterly. That talks about the average investor and what returns they're actually getting. And for the first quarter of 2020, it was like negative 20 something percent. And then you factor out the full last 20 years, which I believe is the longest they go. It's only at like 6% for these indexes.
Right.
So you look at that being a return that is probably a little bit higher than what the insurance companies will yield with a properly designed wealth maximization account, but still the amount of risk that's taken, right, and also the singular use, right, of that type of asset, okay, is something else that you make up for that with something that has much less risk, a much higher degree of certainty, and removes really that risk you're taking to get just a slight improvement in the return.
Absolutely. Well, and then you have to factor in the fees and expenses and ticket charges and trade charges and everything else associated with it. And that 6% average you're talking about drops to 2 or 3.
Yeah.
So really, I mean, in general, are mutual funds worth it? I'd say absolutely not. If you have a very strong opinion towards one sector or one area of the market and you want to take a bet there, fine, do it. Absolutely. Whether it's this area, that area, if you really feel strongly about one particular area, invest there. Don't just throw your money blindly in mutual funds and hope to hit it big, because you're right, you won't. And I guess that's the point with anything in tier 4. It's once you've got everything else set up, then it's about what else do you want to try? Okay, what else do you want to explore? You've already got your wealth maximization account set up. You've already invested in yourself. Maybe you've got some intentional investments like oil and gas in our tier 3 investments for some tax breaks. And now you're saying, I've got this little extra money and I've always wanted to do this. I've always wanted to invest into racehorses or seed money for startup businesses, or I've always wanted to try options, or, great. That's what tier 4 is all about. Let's do it, right? And and like you said, you could take a loan from your policies, get a low cost of capital there to go invest elsewhere, and take the difference, right? Pocket the earnings from there after paying off your policy loans, just like you might do with real estate, right? I mean, Your cash flow from the real estate pays back the policy loans, then you go do it again. So you do the same system. I mean, Tier 4 works the same way. You can use your policy cash values to do that, to invest intentionally in a couple specific sectors or areas of interest, and kind of have fun with it. So I'd say that's your fun piece. It's not your bread money. It's not your food money. It's not your mortgage money. This is your fun money, and that's where you can really just have fun.
Well, one thing too, as we kind of wrap up the whole conversation about all four tiers of the hierarchy of wealth, I mean, in the end, I would say the most important thing I see as the value we give to clients is understanding the end from the beginning, right? Is understanding what results you really want, and what it takes to get there, and getting there with the highest degree of certainty. And invariably, you see, the biggest opportunities most people have is figuring out how to get paid more for doing meaningful work. And that's one of those things where along the way, I think the typical financial planning went sideways is continuing to advocate this retiring at 60 or 65 and having enough money there to last for the rest of your life, where that's no longer feasible. And I'm assuming it's feasible for some, but the savings rates have to be upwards of 30, 40, 50%, or the lifestyle that they live in retirement has to be significantly less than what the lifestyle they currently live. And that's where advocating the importance of continuing to do meaningful work. I think right now with COVID and what we're experiencing as a society is that people want to work, and because they're not getting to do meaningful work, it kind of stifles, right, their ability to have sanity in a sense. Yeah. And I look at just how things are evolving and most likely never going to go back to how work was once. Being able to do remote work, contracting, and so forth, provides tremendous opportunity as you get into Tier 2 and Tier 3. And, getting into Tier 2 and Tier 3, requires some education, but there's some fundamental characteristics there that provide a layer of security, a layer of certainty. Getting into Tier 4, even though that tier is there, it doesn't mean that you have to be there. I have a little bit of money in some crypto things, but just a few $1,000s, right? It's nothing much. It's just something that I'm intrigued by. I want to pay attention to, yeah. But it's not like something I'm trading on a daily basis, right? But it's wanting to be intrigued, but then also just not taking your eye off the main prize, right? Which is you as your best asset, whether it's educating yourself regarding the different investments that are out there, okay, or it's discovering ways in which you can get paid more for what you love doing.
Correct. Yeah, and actually, I want to key on something you said there, and actually you've said this a few times in the past, but stagnation is death, right? Even if you have enough money to retire and you can do the traditional retirement, why would you, right? When the body stops working, it deteriorates, right? The mind deteriorates. Your physical body just doesn't perform like it did. So, the traditional retirement isn't something, we seek or advocate. I mean, that's when you just reinvent yourself. And maybe Tier 4 for a lot of people is simply saying, that's when I shift gears in retirement and start to explore other avenues.
100%.
And that can be your passion or your focus or your new life. It could be, hey, I'm gonna be the crypto master. I'm gonna, this is great, awesome. Make that your passion in retirement and go after it, and make it your new passion. Make it your new way to earn an income, right? Just don't stop working altogether.
There's hundreds, probably thousands of other opportunities that are out there around the world, right? But you hit the nail on the head. I think what people dream about in their future, what retirement is, right, is doing meaningful things. And that's where it's interesting, where I look at, work is something that can be meaningful. It doesn't have to be something you want to stop. And I believe that course can start way earlier than 60 years old or 50 years old. It can start at the beginning of your career. You may not get there for 10 to 15 years, but at least you can identify what the end result is. And it's not a kind of a Stone Age type of principle, which is the retirement idea. So,
right. Agreed.
Well, cool. Chad, you've been awesome, man. This has been fun. I know we're kind of restricted to 30 minutes or so. We could probably keep talking about this for the rest of eternity. But any last words that you'd like to share before we sign off and wrap up our 4-part series on the hierarchy of wealth?
I'd say definitely study that hierarchy of wealth chart. Take a look at the assets that are listed there, kind of wrap your brain around each piece and what you can do with each one. And rather than saying just check the box, try to be intentional about what you're doing and really try to think how you would do certain things and what might intrigue you. Maybe make a little list, make a little list of goals of what you want to accomplish, and then let us help you. We're here as wealth strategists. We're not just here to help you set up a policy and kick you to the curb. You can call us, email us, text us anytime, and we're happy to help you out. Even if it's just to run a quick idea by us, that's exactly what we're here for. Lean on us. With all of us working here, we've got, I don't know how many hundreds of, or maybe even thousands of years of experience. I don't know. There's a lot of us.
Yeah.
We got plenty of experience. So you don't have to do it alone, right? Let us help you.
Plus, the team we have here has done an incredible job at putting resources on the webpage. So check out the Wealth.
Yeah, absolutely.
ParadigmLife.net, and under the podcast are going to be show notes and a lot of resources associated with these different episodes. But Chad, really appreciate it. Thank you for sharing your wisdom, and look forward to being able to do another episode in the future with you.
Sounds great. Thanks, Patrick.
Take care.
I can't believe that we have already wrapped up our second season of the Perpetual Wealth Strategy podcast. Thank you guys for listening, for your support, as well as trusting Paradigm Life with your financial education. You can find all of the links that we had mentioned, resources that we had mentioned in our show notes. Those are available on the Perpetual Wealth Strategy podcast page, which is at paradigmlife.net. As always, if you have questions or you want to have a consultation with one of our wealth strategists, everything's complimentary, and we're here to serve and guide you. So have a great summer, and we will see you in the fall for season 3. Thank you for listening to the Perpetual Wealth Strategy podcast. Be sure to visit the show's official page at paradigmlife.net for appropriate disclaimers and terms of service. Guest opinions are their own. If you require specific investing, financial, legal, tax, or any other specialized advice, please consult an appropriate professional or a wealth strategist at Paradigm Life. We welcome and appreciate reviews of the show. Head on over to iTunes or Stitcher to leave your review today. And don't forget to subscribe to the show to get access to every new episode and its exclusive content. Thanks again for joining us, and we'll see you next time.